We should note that we started the morning very interestingly with some very, very stern comments from real estate billionaire Barry Sternlicht, saying essentially that the economy is breaking hard, cracks are starting to form, and that if Powell doesn't take his foot off the gas now, we will see a serious recession. Now we have the warning from FedEx to sort of button this day. Let's bring in our senior economics reporter, Steve Leisman, for more on all of what has happened. Steve, obviously, you take Sternlicht's comments with a grain of salt. He started talking his book. He's a real estate guy. His whole business is built on lower interest rates. But still, when you add sort of the real-time data that we're getting from a FedEx, you have to wonder whether or not the Fed is going too much full steam ahead with interest rate hikes and not seeing what the impact truly is first.
It's entirely possible, Melissa. I think the argument of people like Barry and other folks is that the Fed is either disconnected from what's happening in the real economy and or operating on old data. I think the Fed might respond in this context. What's happening now and what Barry Sternlicht is seeing to some extent is precisely what they want to see in terms of a slowing economy. Barry is in an industry, Barry Sternlicht, an industry that is taking it on the chin as a result of what's happening with higher interest rates and what's happening in the real estate market. Unclear to me that the rest of the economy is taking it quite so severely. I was looking back at Walmart's earnings report just a month ago. It was fairly robust. Same with Home Depot. The retail sales numbers today were somewhat mixed, depends on how you look at them. And the jobless claims numbers were also pretty robust. So we're definitely seeing a slowing here. Whether or not we're seeing a stoppage, Barry mentioned Walmart. And look, if Walmart has, pardon me, additional guidance to give, it probably should come forward and give it if it's seeing all things stopping. But we're just not seeing that. Tomorrow, Apple's having a pretty big event. They're going out crazy and launching their new electronics, and you don't get a sense from them that they believe the consumer is any sort of a hard stop here, which is what I think Barry Sternlicht is talking about.
The concern, I think, though, Steve, from not just Barry Sternlicht, but also the likes of a Jeff Gundlach yesterday, as he told Scott Wapner, Elon Musk, Larry Summers, not Larry Summers, scrap that, excuse me, is that basically the Fed is doing this, and we haven't seen the impact. So this economy is slowing right now, but those two back-to-back 75-point hikes have not hit fully, correct? And so when that does hit, what happens to this economy that's already slowing?
Almost certainly true, but listen, I take it from two different sides here. First of all, Barry mentioned the idea that he thinks inflation, it's okay to go down to 3 to 4%. That's unacceptable for the Fed. It's probably unacceptable for the U.S. economy. Just look at how difficult it is for you guys to figure out what the heck is going on in this economy right now with inflation the way it is. Retail sales came in this morning. How much of that was inflation? How much was not? How can businesses plan in an environment like that? The Fed is not going to move off of that goal of 2% and say, okay, 3 or 4% is good enough. That's the first thing. The other thing I think that's out there, which is really significant, is the idea that we have to slow down the economy somewhat here. And where do you think interest rates ought to be? Do you believe that we're in a world of low underlying, secularly low inflation, such that we need to go back to the good old days when the funds rate was 1% or 2%? I don't think so. I think you can make a pretty good argument that there's an underlying funds rate that ought to be around 3%. And if you want to be restrictive, it ought to be around 4%. So I feel like there's a good sort of theme out there of some people want to click their heels and go back to Kansas, where the funds rate was 2%. I don't think we're going back there. I think if you're thinking about your portfolio right now, you ought to think about a funds rate and a 2-year bond that is properly in a 3 to 4% range.
I don't think anybody
in the future has a cost.
I'm sorry to interrupt, Steve. I don't think anybody here, at least, is saying that we should, because you're implying an actual pivot from what the Fed is doing. We're just wondering if there should be a pause at this, not a reversal. But let's see where we are, Tim.
And Steve, there's a difference. So let's go back to Sternlicht's term. He said breaking. There's a difference between breaking with an A and breaking with an EA. And breaking with an A is slowing down. Breaking EA is falling apart. And breaking, well, that's what I do here. It's wordsmith. Yeah. But Steve, my question is, so the Fed essentially in July started telling us just this. We really don't know the impact of what our rates and what our hikes have done to the economy. And that was where the market, by the way, got a lot of ammunition to interpret this as a pivot. Fed funds are 100 basis points higher out in April. We're about 445 today. And yet the Fed 2 months ago was telling us that they actually were a little concerned about this.
Yeah, I mean, look, the Fed does not want to break the economy. It wants to break the economy. Throwing it right back at you there, Timmy.
Thank you. Thank you.
The Fed doesn't want to B-R-E-A-K the economy. It wants to B-R-A-K-E the economy, to be more specific. But remember what they've said. If breaking inflation requires breaking the economy, I think they're going to do that. And I think that a mild recession is something the Fed would tolerate here because it sees it has elevated the importance of reducing inflation above economic growth. And it feels, by the way, still that there is some play in this economy, and some of that play comes from what's happening in the jobs market, which is still, you saw jobless claims decline today. You still have a large number of job openings out there in the economy. You still have a labor supply issue. And the Fed is hell-bent on this issue. And look, Ray Dalio and Jeff Gundlach and Barry Sternlicht complaining is part of what you might expect to hear, I hate to say this, if the Fed's doing its job.
Yeah, and I think the idea, too, that they're looking at outdated data, right, and that inflation might actually be coming down is interesting because there is that to support it, although there's probably just as much to support the other argument right now. But I think really we do need to see certain things come down. I think the biggest things right now are going to be a strong labor market, which is wage growth, and also a tight housing market. Those are the things right now that have to come down. So even though we are seeing warnings from places like FedEx, I don't think that's what the Fed is going to need to see, unfortunately, to start to lower interest rates here. So I don't think this is as important what happened next week. I think most people assume it's going to be at least 75 basis points is what they're going to do moving forward. And I think we're going to unfortunately have to see a little bit more pain there before they're coming down.
Steve, thanks as always for joining us.
And just one more thing, Melissa.
Sure.
One more thing. I did get some data today that does show rates in some cities are peaking. I wish I could cite the study that I just read. That's the sort of thing I think the Fed's going to look at. The trouble the Fed's going to have is going to take some time for that to work into the data. And in that regard, I think Barry Sternlicht and others have a really important argument, which is that it may not show up in the data before the Fed sees it. Still, the Fed has to get to a place. The destination is 3.25% to 4%. I think that's where the Fed is going, and that's where the Fed may stop if the data do indeed turn and inflation looks like it's on its way down.
All right, Steve, thank you. Steve Leisman, in terms of the data and things not showing up in the data yet, maybe job losses have not started to hit the data, the overall headline number yet at all.
Yeah, and that's coming in a theory near you when you have the sort of, announcements that we just had tonight.
Good for AMC.
Well, okay, wordsmith over there.
More bad
I'll just say
jokes
this. This is actually kind of setting up a little similar to June. Early June, the S&P sold off 10% into that pivot from a 50 basis point hike, which was consensus, to a 75. And then what happened is we rallied out of it. Now, we rallied for 2 months because a lot of investors thought they were going to do exactly what Courtney just kind of thought about. But here's the thing. The problem now is that if we do rally out of this, because they do say we're going to take our pedal off of the metal right now, they've gotten to the point what Steve just said for Fed funds. They've gotten above 3%. And maybe that is the new normal for now until the next crises. But I guess the way I'm thinking about it is if they are taking a pause, it is because they broke something. I don't know however you want to spell it, because the economy is starting to slow dramatically.
A pause is like is
data dependent or this and that. But maybe it's just acknowledging some of the pressure that's been put on some of the things. Housing, maybe they're going to say we expect unemployment to rise above 4%.
Pause would no longer be a pivot. A pause would be just something.
Correct. And my point is that that's not going to be good for stocks the way it has been in times past. And then if we really do have a global recession that is sustained, then Fed funds starts going lower. And again, maybe that's when you buy the dip.
I just think that the Fed needs to have credibility as well as trying to address the inflation issue. And for them to lose credibility by turning right now, after we're starting to see some progress or no progress on inflation, I don't think they can do it.